Hello and welcome. So, over the course of the year, we will be doing a series of informal fireside chats to educate our viewers. We meant that to be metaphorical, however, we're having a nor'easter outside, and this was the only logical place. On these chats, we will be discussing economics, social media, global trends, new technologies, debating strategies, and listening to engaging professionals within the industry that will hopefully drive further discussions. I couldn't have asked for a better person to start our adventure down this road than former chief economist at Texas A&M University, Mark Dotzour. Mark, appreciate you allocating some time for us.
Thanks. Looking forward to it today.
Let's dive right into it. So recently, the unemployment claims fell to 847,000. What is the outlook for job growth in 2021?
Well, I think it's going to be positive, and I think it's going to be kind of weird because why I'm stuttering a second is because usually I like to try to have really straightforward one sentence answers to everything. And in this case, I'm going to have to expand it a little bit. I think we're going to have two V-shaped recoveries followed by a jobless recovery. How's that for a mouthful?
Hmm.
And what I mean by that is that our government made such a horrendous mistake by locking down the economy. And we saw a loss of economic growth like we've never seen before. And as soon as they lifted the lockdown, we had a partial V shaped recovery. So we'll call that number one. And then I think as we get more and more vaccine out there, that we're going to get a second wave of a V-shaped kind of looking recovery. Pretty good. But unfortunately, let's just say there was 100 units of employment lost because of the lockdown. And we got 40 units of it back with the first V-shaped part of the recovery, and we get another 40 units back, but then we're still 20 units short. And that's where the jobless recovery will kick in probably by the end of the year. And everybody's familiar with that phrase, but it's kind of a misnomer because it's not jobless recovery doesn't mean you're not going to have any jobs. It just means they're going to grow slower than we would like. So the total answer is one V-shaped recovery we've already had, another one we're getting ready to experience when things get better later this summer. And then we'll have probably, I'm going to say 2 to 4 years before we get that last segment of society back to work like they were before everything kind of went wrong.
So, we've had continued strength in the corporate and residential housing investment, which has helped set the economy up for what could really be a good 2021. Now, you referred to the go signal for the economic rebound. What is that, and when will it happen?
Yeah, I feel like there's just an enormous amount of pent up demand waiting for that phrase go signal. And to me, the economic recovery is going to be 100% correlated with the percentage of Americans that have received the second dose of the vaccine. I just checked out those numbers last night from the CDC, and right now it's way less than 1%. So virtually nobody in America has that yet. But in my mind, that's the go signal, and it's going to be kind of a gradual one rather than just an automatic boom, everybody hits out of the starting blocks. But each month that goes by that 10 million people, 20 million people get that second dose of the virus and they feel comfortable enough to go back out to the restaurant or go to the office or take a vacation, that's the go signal. And I'm going to be following it every day on the CDC, the percentage of Americans that have the second dose of the virus.
Mm.
And I think, I'm thinking somewhere around July. I used to think it was May or June. My wife told me I was too optimistic, and I think she's going to be right. But I'm hopeful, and nobody knows, but I'm hopeful that by July and August, there will be enough people vaccinated that feel comfortable that I'm ready to go to that national park and take a vacation and have a real wedding, all of those sorts of things.
Yeah, I think there's a lot of people that are just itching to do that. Now, will there be a difference in the local and regional as far as the recovery?
People asked me that way back last March and April. They'd say, "What's the shape of the recovery? V shape, U shape, L shape, Nike swoosh?" And at that time, I would say it's going to change. It's going to vary from city to city, not just region, but city to city, based on the employment base in that particular city, because some things are going to turn around pretty good. I have a feeling hotel and restaurant is going to turn around pretty dramatically pretty soon, but convention and tourism could be a little slower. And also government employment, because state governments and city governments are under huge budget pressures right now. So cities that are heavily reliant on air traffic, like, well, LaGuardia, for example, or Atlanta or Dallas, Orlando, places like that, air traffic's not going to come back quite as fast. So it's going to vary from city to city.
Which global trends will shape the world economy in the next 10 years?
In the next 10 years, the biggest change in the global economy in the next 10 years is going to be when our monetary policy stops working.
Hmm.
And that's not going to be a pretty day. And that's going to be a day when you're going to want to own a whole bunch of real estate. And for your people in the audience today, I am a real estate economist. I work for the Real Estate Research Center at Texas A&M, but I've never been paid a dime to convince people to buy real estate. That's not what I do. I just talk to people about what's logical and what makes sense. And at some point, our monetary policy isn't going to work, because it's a trick. It works every time so far. When you get into trouble, you have a recession, the Fed lowers interest rates and allows everybody to refinance their 5% mortgages at 3 3/4. That's how we got out of the 2010 problem. We're getting out of this problem by lowering rates even further and let everybody refinance their 3 3/4 down to 2.8. 5 or 6 years from now, we have another recession. They'll drop it even lower and let everybody refinance at 1.5. And
Right.
even after that, another recession, we refinance at 0. And so that puts us out. Two recessions is at least 12 years in the future. But I could see 12 years from now, you get a 30-year mortgage rate, fixed rate mortgage rate at around 0%. And that's when you run totally out of bullets. And at that point, so it's not going to happen for a while. I'm not worried about it overnight, but it's coming.
So, the US economy contracted in 2020 for the first time since the financial crisis, but flourished in the fourth quarter. Uh, how do you feel COVID will impact the US economy this year?
Well, it's going to keep it slow. I feel the reason I use the metaphor of get out of jail card, I have two: a go signal and get out of jail card. The go signal is when everybody goes back and starts buying stuff and working again. The get out of jail card is the vaccine. And so I just feel like COVID, and until we get the get out of jail card, we get enough people with the vaccination, we're in jail. And so it just means a whole lot of stuff is operating at really low levels. A lot of people are surviving, but just barely surviving. And so I see us being in kind of survival mode maybe through June. And then I'm hopeful that we start ramping up pretty good in July and August as people want to do something before their kids go back to school in the fall.
And how does the change in the White House and Congress impact the real estate decisions?
Well, the biggest deal is I read the 110-page Biden Sanders platform, unity platform, and the very first two words were climate change. And so within the first two paragraphs, they said, climate change will be at the heart of every decision we make. And so this time around, I think climate change is going to be a real deal. To be honest with you, I've kind of ignored it over the last 15 years because I'm skeptical of the science, but just because I'm skeptical doesn't mean it's real. I'm not sure myself. But I know a lot of people under 40 years old are convinced that climate change is a real problem. And the Biden administration is going to try to enact things. So what that means is a whole lot of buildings are going to get retrofitted to zero emissions or get subsidies to get retrofitted. What that means is that their goal by 2030 is to change the building code so no new office building or any building will be built that isn't zero emissions.
Think you're already seeing the Ford plants by 2035. They want to be completely renewable.
Wow. Yeah. Well, I've there's a bunch of people be on this call that are my age. I'm 66, just in case you're in the audience think I'm 88. But there's a bunch of people on this call that are my age that have been kind of not convinced about climate change. But this time it's real, and I'll tell you why. It doesn't matter if the science is right or not. What matters is a whole bunch of people under 40 think it's a huge deal. And some 40-year-olds or 30 or 20-year-olds aren't going to go to work for a company that's in a building that isn't a green building. And so it's just like right now today, good luck. If you're Exxon or Chevron, good luck going to any university and recruiting 25-year-old master's students in engineering.
Right.
Because a lot of them just say, I'm sorry, the salary's good, but I can't work for a company like ExxonMobil or Shell or any of the rest of them. And so it translates into office buildings too. I have clients that are major consulting firms, and they tell me that their clients are demanding it. They're saying, you know what, you're pretty good at accounting, you're pretty good at consulting, but if you're not part of the green revolution, I'm sorry, but we can't do business with you. So those big companies are going to move into green buildings because their clients are insisting on it.
So transitioning there, how do you feel the global appetite is for commercial real estate investments?
Well, it's just continuing to explode. So many people in the audience here have heard the phrase too much money chasing deals. We've had too much money chasing deals since about 2006. And if you think there's too much money chasing deals now, there's more money coming. Blackstone raised $8 billion for a debt fund, real estate debt fund recently, biggest one they've ever put down. I've got a lot of colleagues and clients in private equity, and they've got 204 billion in dry powder. Dry powder is kind of embarrassing. If you've gone out and raised 204 billion and you've told a bunch of high net worth investors you're going to buy real estate and make them a 15 or 20% return on their money, dry powder means you haven't invested it yet. And I call those buyers under distress. We've always heard about distressed sellers, but these are distressed buyers because none of them want to give that money back. And in addition to private equity and then Blackstone, institutional investors are piling in again because they've raised their allocation for real estate. Back in the 80s, a 50-50 allocation of stocks and bonds wasn't unusual. And then in the late 80s, they started adding about 5% real estate. And that's grown over the last 30 years. Now it's about 10%. And they've just recently announced again their plans are, as a group, to raise it another 0.5% or so. So that's a lot of money when those pension funds from all over the earth raise their allocation. So I'm still super bullish on real estate because nobody wants to invest in bonds, and the stock market's just a total casino now. It's not an investment option, it's a gambling. It's not even a speculative option anymore. It's largely gambling.
So Wall Street, they made big bets against GameStop's future, but others, they decided to bet on its future instead. Melvin Capital is down 53% for the month of January. Steve Cohen deleted his Twitter account, and some 30-year-old day trader made over $50 million in practically one day. Now, we all want to unlock the new norms, but what are the new norms? And more importantly, how is the stock market and bond impacting the commercial real estate investment?
I've been serving clients in this kind of capacity since 1997, and several things haven't changed. And one of them is an investor makes a decision to go into real estate while they're comparing it to stocks, bonds, certificates of deposit, treasury bills. And so there's no alternative right now. The CDs don't earn anything, the treasuries don't earn anything, the bond market has no return, and the stock market is inflated to valuation levels that people have never seen before. And so there's a real hesitancy there in stocks and bonds, and all that does is funnel more energy into commercial real estate.
We've grown accustomed to lower inflation since the early 1980s. Are you worried about inflation, and what's your outlook?
I think we could see temporary inflation for a year coming forward. When we get the go signal, I think we could see pent up demand that's beyond our imagination. I'm thinking about the only thing that's comparable to what's going to happen here later this summer, if I'm right about the enough people getting the vaccine. I think that pent up demand could be similar to the weeks and months after World War II ended and all the soldiers came home. Everything had been rationed for a couple of years: food, tires, gasoline. And people were saving money and there was nothing to spend it on. And man, when they got home, it was go signal time and there was pent up demand. And in my mind, I see that kind of event happening. And so I think it's going to be really strong. And so, with that said, uh, without stocks and bonds, real estate looks like the only answer. And then I wanted to mention to you, you and I have talked before, but within the food groups of commercial real estate, things have changed a little bit that could change investment demand within those food groups. Because as we sit here today, most people are afraid to invest in retail, and they're even more afraid to invest in hotel. And they're a little skeptical about office just because they're not sure what's going to happen even after the COVID thing dies down. So what that leaves is two most favored nations, and that's industrial and multifamily. So what I could see happening in the back half of 2021 and 2022 for that matter is, suppose a normal $10 of real estate wanted to come into the United States from all over the globe. And 5 years ago, that $10 would be distributed across hotel, retail, office, industrial, multifamily. But right now, if people aren't interested in retail, they're not interested in hotel, and they're a little nervous about office, that means that whole 10 units might get completely focused on multifamily and industrial.
Hmm.
And so, with that said, I could see cap rates continuing to compress even further in industrial and multifamily.
How about long-term and short-term interest rates heading into 2021?
Interest rates is the Fed funds rate. And the Fed has said they're going to leave that rate at zero till about 2023. And I had to chuckle when I heard him say that because I checked the last time they did this was in December of 2009. That's when they put interest rates at zero. And 7 years later, they finally tried to get it off of zero. So when they said, we're not going to raise the rate, we're going to leave it at zero till 2023, I'm thinking, you're probably going to be there more like 2025 or 2027, just like you did the last time. So short-term borrowing costs are going to be cheap. And also savings CDs and bonds are going to have no yield for that period of time too. So it's just going to continue to drive real estate investment demand. The longer term rate, which I talk about with commercial real estate agents, is a 10-year treasury because a lot of mortgages are based on the 10-year and cap rates are somewhat correlated with the 10-year. And I think that's going to stay low too. I've been talking about that for 23 years now, trying to help people my age that are waiting for runaway inflation and high interest rates and not buying property because they say yields are too low. To understand, this is not the 1970s anymore. We haven't had inflation in this country since 1982, and that's getting to be like 38 years ago. And there's still people that are watching this call waiting for runaway inflation and think it's going to happen. But I
So
don't.
to backtrack to the cap rates, there's an insatiable appetite for industrial real estate these days. You got New Jersey and California are the two more sought after markets. And despite the low cap rates looking painful on paper, those markets have outperformed year after year after year. Where do you see the long-term trend moving for cap rates these days?
Well, it's going to, I used to, a year ago, for the last 19 years, I would say they're going lower. End of story. That'd be the end of the discussion. But what we have to do is it's a little more complex now because cap rates are a function of two things. The overall interest rate, say on the 10-year treasury. And so when that goes down, cap rates go down. But the second part of commercial real estate is coming into play, and that's the perceived risk of the asset itself.
Right.
So even within industrial, let's say, let's just use that as an example. I would say that the overall investment pressure for industrial is going to continue and be even stronger. So if the 10-year treasury doesn't go up at all, and the perceived risk of industrial stays low, and the perceived demand for industrial stays strong, I could see cap rates continuing to compress. And you go, well, how far can they go? Well, we don't know. But if you're a German, one of your opportunities is to put your money in a 10-year German bond and lose 0.5% per year. So a 3 cap on industrial or a 4 cap on industrial looks like a gold mine compared to negative 0.5% in the bond market over there in Germany. So, but the flip side of that, to illustrate my point, is take office buildings, for example. The 10-year treasury isn't going to go up much, so that's not going to pressure office cap rates to move up. But I would say that the perceived risk of investing in office right now is higher, simply because you can't really predict how much absorption is going to happen. And the same way with retail and hotel. So in a certain way, I could see cap rates compressing in industrial, maybe continuing to compress in multifamily, and at the same time increase in retail and hotel because of the perceived increase in risk associated with those property types. Does that make sense?
It does. It totally does. Let's transition into a quick outlook for for investment in the four food groups of retail, industrial, multifamily, and office.
Okay, well, I'll start with multifamily. And at age 66, if I get lost and forget which ones I haven't talked about, you tell me, okay? That's going to be your job. But let's start with multifamily. My particular favorites are Class B and C multifamily because you can't build it. In my mind, the only asset class that has negative supply is Class B and C multifamily. Everything else can be built and replicated on a new site. And so I see that that's probably my favorite investment from my perspective. And so I think cap rates can continue to compress there because they're just not making any more Class B and C apartments. I don't care for Class A as much, number one, because they're in the urban core, and I'm skeptical of the urban core right now. And so, and also you can build a lot of Class A. So that I see a lot of opportunity in multifamily. Industrial, the same thing, most of it related to warehouse and distribution. The issue of getting those goods and services to that last mile of customer, that's still an issue. It hasn't been totally resolved yet or solved. And so I could see a lot more demand for that. And you know what? We might even see some more demand for manufacturing because our supply chain with China and other places is broken. And you find out when China decides they don't want to ship you something, it's kind of a nuisance. And so I think people are going to bring back some manufacturing, some parts of the supply chain back to the U.S. So I'm bullish on industrial too. Office, I love the office buildings, but this is an unanswerable question today. Is if you have a building with 1,000 tenants 1,000 workers in your building, and right now there's 8 in the building at all, you can't really know whether all 1,000 of them will show up again once we get the go signal, or if maybe 80% of them do, and the other 20% work from home because the boss said it was okay. And the boss may be coming looking to the landlord to say, when we renew my lease at the end of the year, I'm going to be looking for smaller square footage. So right now, office is is in the penalty box, if you will. It hasn't been disqualified. It's just like, we don't know what you're going to do just yet. I think there's some real opportunity in retail and hotel. And the key thing about those are when you have an asset class that has some risk associated with it, let's just focus on retail. It would apply to hotel, but not every retail property in America is going to get ruined by Amazon. There's plenty of retail properties in this country that will fully thrive and survive regardless of what Amazon does. And so that's where you rely on real estate pros in the business to help you understand which properties are going to be here 5 or 10 years from now and which properties are getting disrupted overnight by e-commerce. So when you have an asset class like retail where there's a lot of questions, the cap rates go up. And a lot of people are attracted to a high return if you can understand the risk that you're taking.
But you're also seeing some conversions too, with retail going into industrial. And I appreciate you condensing your comments there on the outlook before my shirt actually caught fire. Thank you. I didn't realize it was going to be this hot. So speaking of which, let's end off. Why don't we end off with renewable energy? You know, the current administration has touted its importance and is making some great strides pushing for it. We talked about Ford trying to expand their climate change goals. And announcing that 100% of their manufactured plants will be renewable for energy, whether that be hydropower, geothermal, wind, or solar. Where do you see renewable energies going in the next few years?
I think this is a real deal this time. I believe, like I said, I'm skeptical and somewhat indifferent on the science. I don't think anybody can prove it one way or the other. But the fact of the matter is, it's a real deal when it comes to real estate investment. And so I see a lot of energy and focus going towards those renewable energy sources that you're talking about. They're going to create jobs, and I think it's the future. The caveat is that the government can destroy oil and gas jobs faster than they can create new green energy jobs, because you need some tax benefits and some tax subsidies to get that going. And with an executive order, you can destroy a lot of the oil and gas business overnight, but it could take you a couple of years to get the tax changes through Congress, and then another couple of years after that to see any real employment coming out of it. So I think it's coming. I'm fairly confident it's coming. It's just, this is where that jobless recovery comes in. Good way to wrap up. Once we get back open for business, as we shut down oil and gas related jobs and coal related jobs, those jobs go away immediately, and it's going to there'll be a lag before those can be replaced with green energy jobs. And that's why I think we have this slow jobless recovery that will keep interest rates low, which will keep cap rates low.
Mark, always a pleasure. Thank you very much.
Well, thanks a lot for inviting me. And for all of you out in the audience, you know it as well as I do. We live in the best place on earth, the United States of America. You can't find a better place to live and work. So knock 'em dead and have a great year.